What's up everybody, Gen X Dividend Investor here. In this video I'm going to analyze the subscriber's dividend portfolio that was sent to me asking for my feedback, so I'll quickly go over their stocks and then I'll give an overall rating of thumbs up or thumbs down. And if you appreciate videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Note, I'm not a professional wealth manager, so don't take anything I say as financial advice. I'm just someone who is passionate about dividend investing, and I'm on a mission to educate the world on how amazing dividends are for true passive income and their ability to help you retire early. I plan to run a poll on the community tab of my YouTube channel so that you can vote on this portfolio. That way we can see how everyone feels about it, not just me. In the last subscriber portfolio review I did, I said that I barely gave it a thumbs down for a variety of reasons, and then 629 people voted and about half agreed with me. It was actually the closest ratio of thumbs up to thumbs down that I've had in these portfolio review videos. And if you'd like me to review your portfolio in a future video, then Instagram me your dividend portfolio at Gen X Dividend Investor, as well as info about yourself like your age, goals, career, retiring timeline, investing experience, etc. And maybe I'll highlight you in a future video. If there's anything you don't want me to share publicly, then mention that as well. I have a bunch of people who've already submitted portfolios for me to review, and when I do these videos I don't pick them based on the order they were submitted, but instead based on what I think would be interesting and valuable to watch. So today's portfolio came to me from a Patreon aristocrat subscriber of mine named Jangles. I'll quickly tell you about his background and then I'll go over his portfolio. Jangles is 26 years old and has been in the military for 8 years now, so he joined right out of high school. He currently is focused on becoming an accountant and should be done with his bachelor's degree in the next year and a half, and then he plans on using the GI Bill to get his master's. He got married at 19 and his wife is training to be a lactation consultant. I think lactation consultant would have been a job I liked in college. Anyways, they have 2 wonderful kids and he told me that he and his wife were completely financially irresponsible when they first got married. Like they weren't saving or investing and they just spent money as it came in, which is what most people do. So because of that, they sometimes carried credit card balances, which is a big no-no. Using credit cards for perks is awesome, but you gotta pay off your balance in full each month. Jangles grew up in a household where his parents never invested or owned stocks, but he was always interested in them. When he was a kid, he never spent money and he just saved it, which was smart, and when his mother lost her job in the 2008 crash, he was able to bail her out. Very impressive. Over the years, Jangles heard about the FIRE movement, and since he was interested in retiring early, he started researching stuff on YouTube. So kudos to him for going down a better financial path than his parents. I'm always impressed with people who can do that. He came across dividend stocks and he felt that a lot of videos weren't very clear, but he liked how I dumbed things down enough so it was easy to understand. Jangles realized that he and his wife needed to go down a better financial path, so they started saving and investing. Now they put away about 40% of his take-home pay, which is awesome, and congratulations. Even more impressive to me is this. He bought his first stock on February 19th of 2020. Why is that impressive? Well, take a look at this chart of the SP 500. Poor Mr. Jangles bought his first stocks like literally days before the pandemic crashed the markets over 30%. And what really impressed me is that he kept on investing even though he took a gut punch right off the bat. So big crashes is one reason why some people like to dollar cost average rather than lump sum invest. Now so many people would have quit at that point because that loss would have been too much, and I think it speaks a lot to this guy's character and drive. Awesome. He said his goal is to get to a 6-figure portfolio in around 4 years, and I bet he'll make it. He mentioned he's made lots of investing mistakes in the almost 2 years he's been investing, doing things like buying high and selling low, selling things he should have held onto, and FOMOing into things like Virgin Galactic. Right now he's focused on dividend growth stocks and he hopes to not touch his investments until around age 40, which is when he'd like to retire. A good thing he did was open up custodial accounts for his kids, and he went with VTI and VGT for them, which I think is a good move. VTI basically means all the US companies, and VGT is a Vanguard ETF that focuses on tech stocks, so long term I think it'll do well. And while VGT is a subset of VTI, it just means his kids' accounts will have a greater portion of tech stocks relative to the overall market, which I think is a decent move. For reference, a custodial brokerage account is something you open and manage on behalf of a younger person, like your kid. 2 of the most popular types of custodial accounts are the UTMA account and the UMGA account. The accounts are pretty similar. Both can hold stocks, bonds, and cash, but UTMAs can also hold real estate and vehicles. Generally speaking, a custodial account transfers into your kids' control when they are between 18 to 21 years old, depending on the state you live in and the account type. And even though you're managing the accounts for them, your kid is the ultimate owner. That also means that once you put money in, it stays in. Kinda like how Oompa Loompas only ever went into Willy Wonka's chocolate factory, they never went out. Now, UTMAs and UGMAs are not tax-sheltered accounts, so that means that you contribute funds to them after taxes, and you may pay taxes on earnings in them, But some amount of earnings are tax-free, and then some amount are at a nicer 10% kiddie tax rate, and then any earnings over $2,100 are taxed at the parent's rate. A downside to accounts like these is that they can count against future financial aid your kids might seek. Anyways, there are other pros and cons to them, but I just wanted to explain the basics, and there are also other kid accounts you can research like 529 plans or Roth IRAs or etc. Jangles has his accounts in my portfolio spreadsheet tool, and it's a down day today on Wednesday, October 5th when I was doing this, thus you see lots of red. He has 20 stocks and a portfolio value of about 35 grand. So nice job on building a portfolio of that size, it's great for your age. Most experts recommend having between 20 to 30 stocks. VTI is his largest position. Then you can ignore the account column, as my spreadsheet tool lets you have stocks in multiple accounts, which you can name, and then when you view your portfolio you can either look at individual accounts or you can select all to see a summary of all your accounts. He has 23 shares of VTI, which is about 12.5% of his portfolio, which means he owns around $4,300 of it. His average cost per share of VTI is $203.32, which means that across all the buys and sells that he's ever done of VTI, his remaining shares were bought at an average price of about $203 each. The average cost per share is highlighted in green as a visual indicator the stock is currently trading at a cheaper price than your average price, as a way to tell you they might be interested in buying more. Then we see that price, daily change, percent daily change, and overall daily changes are in red because VTI is down today. In fact, the only stock of his that is up today is Visa so far, which is a bit further down in the spreadsheet, but you can easily see that green price row in the sea of red. Then we see his unrealized gain or loss for VTI is also red, which means he's down, as is his total return, which means stock appreciation added with dividends received. So overall VTI has gone down 8% from his buys, and since he's gotten some dividends, then his total return is down 5.6% from when he bought, and as I mentioned, he currently has around $4,300 worth of VTI in his account. I think he's smart to focus on inexpensive broad market ETFs like VTI. If we look down below, we see that his overall portfolio is down 7.11% from when he started. Next, he has a dividend ETF in SCHD as his number 2 stock, worth 9% of his portfolio, and it's an ETF that I happen to be long in as well. SCHD is a nice way to get dividends without dealing with all the micromanagement of tracking individual companies. SCHD was created about 11 years ago, and it has surprisingly slightly outperformed VTI in total returns and dividends paid, which is awesome. Then he has Vanguard's technology fund at 7.7% of his portfolio, so like he's done for his kids, he clearly believes in tech enough that he wants to go heavier into it, as there is overlap amongst his other ETFs. So like Apple and Microsoft are both in VTI and VGT. Then he has AbbVie, a great healthcare dividend stock I'm long in. I actually expect AbbVie to be announcing a dividend hike this month, and I just started a poll yesterday on my Twitter asking people what they think the raise will be. As of this moment, it looks like the majority of people are guessing that AbbVie will raise their dividend between 4 and 8%. The real X factor in AbbVie is Humira being opened up to being copied by generic brands and how that might impact their revenue as time goes on. So that reality might act as an anchor on how much they raise their divvy. Here's a dividend raise history screenshot from Street Insider, which shows you how they've done in the past. I love looking at trend data like this to see how they've done historically. So like the last hike was announced on 10/29 last year, and they increased their dividend by 8.5%, aka they were at $1.30 per share per quarter, and they raised it to $1.41 per share per quarter. Then if you look at October of 2020, they did a 10.2% raise, and before that was an 11.5% raise. But that was also when Humira, which is their big revenue workhorse, was carrying the load. Thus, people are now guessing that they'll do a smaller hike than they did historically. Okay, back to Jangles' portfolio. After AbbVie, he has Apple, which is actually the largest position in my portfolio, and is a great tech company. Now, Apple was a stock I didn't used to own, even though I loved Apple computers since I was a kid. My cost base on Apple is under $70K, but it's worth about $250K in my portfolio at this moment, which helps explain why it's my largest position, even though I didn't originally think it would get that big that fast. Microsoft is currently in my second largest position, but in the past I slowly sold out some of those shares to go into other stocks. That gave me more income now, but impacted my total returns. And Microsoft is one that I originally got into decades ago. Anyways, I'm really excited to see what the Apple car looks like, assuming they ever release one. After Apple, he has Home Depot, which is a great consumer discretionary home improvement company that I'm also long in. Then he has a solid tech semiconductor company in Broadcom. Next is a great tech data processing company in Visa. Then he has a decent REIT in American Tower Corporation, which is a global telecommunications real estate play, i.e. cell towers and such. Next up is Pepsi, one of my favorite consumer staples snack food companies that I'm long in, and they just became a dividend king this year, i.e. this was their 50th consecutive year of dividend increases. How cool is that? Next up is Costco at around 5% of his portfolio, and they're an awesome consumer staples hypermarket that is often an expensive stock, but I still love them. But good stuff can remain at premium prices for a long time. Next, he has another solid chip company in NVIDIA. After them, he has a great financial company in JP Morgan Chase. And then he has another great tech company in Microsoft. So he's kind of triple dipping into Microsoft, though it being in VTI and VGT only pushes it up a small amount from its weighting percentage basis. If I had to invest in only one company in the world, it would be Microsoft. After that, he has a great aerospace defense company in Lockheed Martin. A few days ago, they announced a dividend hike of around 7%. Cool. And remember, don't hyperventilate that their increase was less than inflation this year, as inflation has historically been around 2 to 3% a year, and Lockheed's increases have been around 9% a year. Focus on trends, don't tunnel vision on 1 year, unless you think that 1 year is indicative of what will keep happening in the future. After LMT, he has a puff company in Altria, one that I'm also long in. We were just chatting about Altria on my Discord, and I realized that my quarterly MO payout in my taxable account alone is more than my monthly mortgage payment. That blows my mind. After Altria, he has Lowe's, which is a great company and is a key competitor of Home Depot's. Then he has a popular dividend stock in Johnson Johnson, which is a top 5 stock in my portfolio. For reference, JNJ plans to split into 2 companies, one for consumer health products and another for pharmaceuticals and medical devices, probably by November of 2023. The consumer health division will comprise $4 billion mega brands and 20 brands that are each worth more than $150 million. So we're talking Band-Aid, Tylenol, Neutrogena, and Listerine and such. The new spin-off will be named Kenvue. Johnson & Johnson's consumer division has faced nearly 40,000 lawsuits of billions of potential dollars, alleging its baby powder and other talc products contained asbestos, which the company denies. In October, they created a separate subsidiary called LTL Management to hold the talc liabilities, which then filed for bankruptcy protection, a process known as a Texas two-step. I believe JNJ said that its breakup decision had nothing to do with the talc litigation or the bankruptcy maneuver. We don't have any details on how the dividend might be paid by the original and/or spin-off company, so stay tuned. Anyways, I wonder if they used the same branding company that came up with IBM's spin-off Kyndryl. After J&J, he has a trash stock, aka Waste Management, which is another solid company. And then his final position is in Amazon, which isn't a dividend stock but is still a great company. Jangles has done a good job of investing in quality companies, which is what I urge everyone to do regardless if they have a dividend or not. My kids' accounts are focused in Google, Amazon, Microsoft, and Apple, so more concentration and are split 50-50 between dividend payers and non-payers. If I scroll to the right a bit, we see that he's making about $813 in dividends per year, and his portfolio's average weighted dividend yield is a nice conservative 2.32%. I like low starting yields in a young person's portfolio, as that usually means they are more growth-oriented, and in this case we see that his dividend CAGR agrees with that guess, as it's a nice high 12.8%. A more conservative dividend growth rate would be lower, maybe 7%. What some people do is they focus on total returns when they're younger, and as they near retirement they shift to higher yield income stuff. We also see his yield on cost is a bit lower than his current yield, since the stocks have gone down a bit since he bought. I see that his portfolio's average weighted PE is 19. A 15 PE has been the historic market median, so a 19 tells me that broadly speaking his stocks are probably still a bit expensive, or just that his stocks run hot. And it doesn't make sense to always use PE for all stocks, so I'm just talking in generalities. Okay, let's scroll a bit more to the right. Here we see that his portfolio's average weighted beta is a conservative 0.65, as opposed to the overall market, which is at a 1 beta. Remember, beta is a measure of a stock's volatility in relation to the market, and a stock that swings more than the market over time has a beta above 1. I tend to like less volatility if you're older, and more volatility if you're younger. Of course, if you're a more active investor, then you actually like volatility because it gives you more opportunities to exploit the swings. Okay, this next part of the spreadsheet I call the calendar view, and it shows dividends you've received in the past, as well as estimates of what dividends will be paid in the future, and it shows the monthly amount of dividends that have paid out and should pay out. So like we see that AMT paid out $11.41 of dividends in April to him, then paid out $11.72 in July, probably because he reinvested them or they did a hike, and they'll pay out $12.11 in October. Isn't compounding beautiful? I love it when I'm reinvesting dividends and I can see that my payouts are increasing over time. Speaking of reinvesting, here's a fun section of my spreadsheet product which estimates how your dividends should grow, depending on if you don't drip them on the top row versus if you do drip them on the bottom row. It also estimates what your monthly, weekly, daily, and hourly passive income is, and I think I was the first person on YouTube to break it down that way. Anyways, we see that right now his portfolio yields $813 a year, and if we look out to year 10, then this estimates that even if he hadn't been dripping that entire time, but his companies had been increasing their dividends like they had historically, then he'd be making $2,715 a year in dividends. Not bad for doing nothing. If he had been reinvesting his dividends during those 10 years, then this estimates that he would be making $3,565 a year in dividends. Nice. The dividend payout growth estimates go out to year 30 in my spreadsheet, so you can really see how crazy things can become. It's probably not likely to happen, but it's possible. So here at year 30, it estimates he'd be making about $30,000 a year if he weren't reinvesting his dividends, or he could be making an awesome $111,000 a year if he had been reinvesting them for 30 years and his company's kept hiking. Note this doesn't account for inflation or taxes. And here's a graph of those dividend growth estimates over time of no drip versus drip. Okay, now let's take a look at your sector composition. A simple rule of thumb I like to use is to broadly align personal portfolios to the overall market sector composition. Like look at VTI's sector weighting and then roughly model your portfolio after that. And the sector composition right here isn't factoring in the sector weighting of various ETFs it holds. So about 29% of his portfolio are ETFs. Then we see he has about 8.4% in healthcare, 22% in tech, 9.7% consumer discretionary, 9.4% financials, 5% real estate, 5% consumer staples food beverages, 4.8% consumer staples household goods, 4.3% industrials, and 2.8% sin stocks. He doesn't hold any single stocks that are in materials, utilities, energy, or telecom, so something to consider. Energy stocks have saved my portfolio this year. Of course, since you have some broad market ETFs, it means you actually hold some materials, energy, etc. stocks. Okay, here's a view looking at his dividend income by ticker, and we see 14.2% of its dividends come from SCHD, 9.1% from VTI, 11.4% from AbbVie, etc. And then here's a view of the dividends he's received over time. So the most recent month is furthest to the left, and then as you go to the columns to the right, it represents dividends received in history. Anyways, overall I like what he's done with his portfolio, and so I'm giving it a thumbs up. Of course, the most important thing here is not what I think, but instead that he's investing, so congrats on starting so young and not quitting. I'm very confident that in the long run he'll end up in an amazing spot with his portfolio. Just live frugally and invest for decades in quality companies. I'll leave a poll on the community tab of my YouTube channel, where you guys out on the interwebs can vote either thumbs up or thumbs down for Django's portfolio, and then I'll share those results in the future. Remember, if you'd like me to review your portfolio, then Instagram me your stocks at GenXDividendInvestor, as well as info about yourself like your age, goals, career, retiring timeline, investing experience, etc. And maybe I'll highlight you in a future video. If there's anything you don't want me to share publicly, then mention that as well. Okay, now I'd like to shout out my latest Patreon aristocrats who have recently signed up. So thank you MathWiz, thank you Starboard, thank you Oxter, thank you Jason G, thank you JSC Dillo, and thank you Ren Takashi. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they gain special access to various private channels on my Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnail I should use, and of course you get more direct access to me. I'm near or I'm at my cap for how many aristocrats and kings I'll allow, so if you really want to join, then refresh my Patreon page every so often to see if a seat is available. I try to update the seats on a frequent basis when someone quits or when we automate things enough to be able to support more people. Finally, I urge everyone to join my free Dividend Discord chat server, which has thousands of dividend investors on it from around the world. Here's a comment I got from someone on my Discord named Ron who's living in Europe. He said, "Your Discord is very helpful to pick ideas, see chats, etc. Thanks for all the info you share and for this amazing Discord you've created." So join up on my free Dividend Discord and you'll get to chat with nice dividend investors like Ron, or you can just lurk and absorb what other people are talking about. Regardless of what you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.